Hi, and welcome to the Trading Bell. Now, the Finance Bill has been tabled in Parliament, that is the Finance Bill 2025, and is currently under review by the Department Committee on Finance and National Planning. For us here, at these initial stages, we want to have a conversation and dissect what are the contents inside it, and what does it mean for you as well in the investment side of things and also in the business landscape. I'm joined by Fredrick Kimotho, Associate Director, Deloitte East Africa, and also the Tax Policy Lead right there at Deloitte. Welcome to the show. I just want to start by asking you, I'm sure you have already looked through, or you're already even looking through, and probably also planning to go to Parliament and give your submissions on this particular bill. First of all, when you look at it, just at an overview level before you get to the details, what is your key takeout?
Looking where we are coming from, the Finance Bill of 2024 and now the Finance Bill of 2025, I would probably not even give a very fair comparison between the two, in the sense that if you remember the Finance Bill of 2024, it was actually more on leasing additional revenue. The amount it was targeted to leasing was around 345 billion Kenya shillings. Which is quite an amount. Yeah, it's quite ambitious. So of course you had new taxes, new frontiers being touched. So when you look at the Finance Bill of 2025, which is the topic of the day, you actually realize, a scenario where we are not going into introducing new taxes. It's actually more of what I would call rationalization of tax expenditure. So we are seeing a bit of exemptions being removed, a bit of incentives also being removed, a bit of cleanups here and there. You remember we had a Tax Laws Amendment Act of 2024 that became effective on 27th of December of 2024. There were a few things there that did happen that this bill also seeks to probably overturn or maybe correct. So over and above, I look at it as one that is probably just responding also to what the outcry that was raised by the citizenry in terms of the government not going so much on new taxes. But there's quite a bit of things that will also maybe touch on the common man.
Let's get to some of the components. I was trying to also pick up a few things here and there from the bill. And I want to start from the income tax and on the employee and corporate side of things. Let's start with what we have been calling, I think there's been a lot of talk on the PDM threshold increases. And for me, the question is, what is the real impact of this new PDM threshold on employees and employers from a compliance and administrative burden perspective? I'm sure you have chewed on that.
From an employment taxes perspective, actually for the first time, looking at the previous 2 years, employees have actually probably been the most impacted, because you remember there was introduction of that 2.5%, that 5% of the tax bands, quite a bit of things, including housing levy and the levies that you have seen, including the SHIV. Under the Tax Laws Amendment Act, we also saw the employee being more or less given back a bit. You remember there are a few changes in there. And I think we continue to see that even under the Finance Bill of 2025, only that for employees now, it appears like the changes are very, very few. Actually, the one that you have mentioned is the most monumental one, where the bill is proposing to increase, the PDM threshold from the current 2,000 Kenya shillings to 10,000 Kenya shillings. Basically, what that means is that if you're an employee and you're working out of your area, so you are then entitled to some PDM. So currently, if you're paid 2,000, you need not to account for tax on that. So it's basically tax-free. I would then say that maybe taking it from 2,000 to 10,000 is just probably, aligning it with the economic realities, because you can be sure that even accommodation, that the cost of accommodation, of course, has gone up. There has been inflation, those kind of factors. The only question is whether probably it has been informed by some sort of research. But also there has been the question of also harmonizing what our colleagues in the public sector are getting and what the people in the private sector do get, because the public sector more or less relies on what we call the SRC guidelines, which the threshold are a bit high on that side. So it's a good one to have. I hope the employees will feel like they have been given back something.
Let's move on now to another part. And this is the pension withdrawals and tax exemption. And I put out this question so that at least we can understand, because there's a lot of pensioners who really want to know what is in it for them. Does increasing the tax-free withdrawal from pension schemes offer meaningful relief to to retirees, especially in light of inflation? Because there has been this particular introduction of increasing the tax-free withdrawals for pensioners.
It actually does. And I think the general policy framework that the government has put out, maybe through what we call a medium-term revenue strategy, is where we move to a model that we call exempt.
Yeah.
I'll explain what that means.
Yes.
So it means that when you're contributing, you're exempt from tax. When you invest, that income is also exempt from tax. And when you withdraw, it is also exempt from tax. So we have seen a bit of changes in the last couple of bills that we have probably seen, just trying to rubber stamp that so that then you can encourage the culture of saving. So the thresholds being increased is a fantastic move, and we believe maybe you'll see some bit of traction as far as that one is concerned. I must say that for the finance bill of 2025, the main thing that has happened is the gratuity, because gratuity had been left out. Gratuity now has been included as part of what we have under the first schedule of the Income Tax Act, meaning that also the withdrawals then would be exempt, which is obviously a welcome move.
I just want to put some color into it, just to help our viewers as well understand what was happening previously when you wanted to withdraw your pensions, and what is the government really trying to do now?
If you contributed anything below 20,000 before December last year, then that was exempt from tax. But then should you contribute higher than that, because the 20,000 threshold had been with us, I think, for many years, I think over a decade. So then the question was, are we aligning with the realities in terms of what is happening? So fast forward, what then happened is that threshold was reviewed from 20,000 Kenya shillings to 30,000, which is 360,000 per year. So basically, it's just trying to review the thresholds from all the facets, be it contributions and withdrawals as well. Now, for example, for the 65 years old now, when you're withdrawing pension, then it will not be subject to any form of tax, which is a good move. There's a time it had been deleted, whether inadvertently or knowingly, which obviously is not very good for our senior citizens. Yeah.
Let me move on now to the capital gains tax, especially on NSE listed shares. I'm sure we are at the NSE. This is subject to interest as well. So what are the broader implications of removing this capital gains tax exemption on listed shares for capital markets growth and investor sentiment?
It has actually not been removed as per se. Actually, the change that has happened at the finance bill is a positive one, if you ask me, because we used to have the exemption of gains that you derive on securities that are traded within the stock exchange that is licensed by the Capital Markets Authority. But that exemption had been provided under the third schedule of the Income Tax Act. So basically, it had been provided where it more or less would appear that exemption was only applicable for companies. What has happened under the Finance Bill of 2025? That provision has been deleted and moved back to the first schedule, to the Income Tax Act. What basically means is that the exemption continues for companies, but most importantly, we now have it very clear that even for individuals, when they trade securities, the gain that they make is actually exempt from tax. So it's a positive move, I must say.
All right, I want to move on now to this different section of the business and company taxation, which I know is also of very much interest to the people who are here. And there's this limiting tax loss deductions to 5 years. And I thought that's a welcome move, but I would want to hear your sentiments. So how does this change impact startups, businesses that experience long-term capital investment before profitability?
One of the discussions we have had as a country, for many years, is how predictable and how stable our tax policies. So if you look at that provision alone, I think I have seen it evolve from where the tax losses used to expire within 5 years, the current year and 4 succeeding year. It then went to 9 years, 1 year, the current year, 9 succeeding years. It was then removed so that then the losses, you carry them forward in perpetuity. Now we seem to have gone back to a limit of 5 years. So it's more or less paint a picture of a policy that is not very, very stable, which then would negatively impact on the businesses. So maybe then, to answer your question, it certainly will have major impacts on capital intensive businesses, because now they are not able to carry forward the losses, even when the losses have been genuinely incurred.
Still on the business and company taxations, we have this advanced pricing agreements, APA. I'm not sure what they are aiming at with this. What are you seeing with it?
What it basically provides for is that now, as a taxpayer, and you're dealing with multinationals in what we call, you have related party transactions, you can now approach the revenue authority in advance and mutually sit down and agree that this is how I'll price my transaction. So what it basically does is to give you a lot of certainty, even as you do your business. Of course, it is going to be entered into for a maximum period of 5 years. So then you're able to agree with the commissioner in advance that this is how I'll price my transactions. As a result, it preempts a lot of disputes. So currently, what is happening is that you want to have a related party transaction, so you just do, maybe you engage a consultant, or you just do your benchmarking, then you just agree that there's a price I'll charge my related party. So the revenue authority comes to you 5 years down the line, and they tell you, you know what? You have been charging very little. You needed to have charged more on this particular transaction. And we have assessments that are going into billions as a result. So the advanced pricing agreements now is certainly a very positive move. It actually aligns with the global best practice.
Fair enough. There's this one, 100% wear and tear deduction. That should be good news.
What happened on that specific one? And that's why I told you, remember in my preamble, the bill appears to focus more on the expenditure side. So actually what has happened for that one is that they have deleted. They seek to delete the 100% reduction that is provided for under the law. So currently, if you, for example, invest more than 250 million in form of capital expenditure, and you're outside the city of Nairobi and Kisumu, or Mombasa, sorry, it's Mombasa, then you end up getting 100% deduction on the capital expenditure that you have. The same case applies to investments within a special economic zone.
Let's move on now to VAT-related changes. And I picked out 4 areas, but first let's start with, very quickly, the deletion of refund claims from withholding VAT.
It's certainly not a very good move, if you ask me. It's not good for businesses, because what you're technically saying is that going forward, businesses will not be able to apply for refund, even when it is very clear that it is arising from withholding VAT. And basically how withholding VAT works is you are registered for VAT, you supply to someone who has been appointed by the government to be an agent, they then withhold 2% of that in advance, and then they limit to the government. So the fact that it is now being dropped, then it certainly means that it may affect some of the players in the market, given that they are not able to claim it. But most importantly, in my view, Mr. Maina, on the withholding VAT, it's one of those taxes that I feel have been overtaken by time. The main reason as to why the government introduced it was, one, to do with compliance. You want to ensure that someone supplying, the government has visibility on someone X supplied to government, and this is the match that they made from that particular transaction. So at the end of the day, then there's no possibility that you'll not declare that income, and if you don't, they'll come for you. And number 2, of course, is from a cash flow perspective, which then the government is able to manage. But from a business side of things, of course, it impacts heavily on their cash flow, because remember, someone is withholding 2% upfront. They're not able to pay you that amount. And number 2, also, it's a compliance burden, and a big one for that matter, because you actually account for withholding VAT every 5 working days. So if you look at the reasons, especially the one for compliance, now that we have things like e-teams, we have done a lot on technology. In my view, I think it is one of those that then you don't have to keep doing that withholding, so that then you eliminate this compliance burden on taxpayers. And also you are able to help them manage their cash flows better. I don't think cash flow should be the biggest headache for the government.
Let's talk also about the refund timeline. It has been reduced from 24 to 12 months. Good or bad?
Bad. And the reason I say bad is because it's more or less like disallowing someone a credit on a technicality. So you're basically saying that businesses should track their refunds, and anything that goes above 12 months and you have not made an application with the revenue authority, then you're considered to have been time barred, and there's no conversation. So if it's a billion or whatever number, then that one is gone. basically on technicality, if you ask me. But I think I get where the government is coming from. I'm probably trying also to harmonize that timeline with other form of taxes, because I think for other transaction taxes, the timeline was 12 months. But for VAT, it was never amended when the other laws were being amended. So we now have that one as 24. So it's basically bringing them to speak to each other.
So there's now this other part of zero-rating items moved to VAT exempt. For example, pharmaceuticals, electrical vehicles, solar tech, all these zero-rated items moved to VAT now exempt. What's your take on that?
So again, as part of the policy that the government appears to have adopted, I think if you look at the medium-term revenue strategy again, you'll actually notice that there's broad pronouncement that there will be review of the tax expenditure. And basically the tax expenditure is in form of the exemptions that we have, incentives, preferential tax rates, and those kind of things. So I think we also expect to see more of those as we go along, things moving from zero-rated to exemption. Of course, you know what that means, and things moving from exemption to standard rated. So we expect to see a bit of more of that. What worries me is the risk that you have, that we are looking at, because pharmaceuticals are quite critical, for the citizens, and also looking at the agenda that the government has for the health sector. But you also notice that now they're being moved from one place to the other. So that's the biggest worry. I think what we should then encourage the government to do is probably to look at what is, because there is a reason why some of those things were put where they were put. So maybe it's to encourage them to look at the risk and do it in the form of priority, and so that then we can also have coherence in terms of the broader policy and what the changes that we're going to see.
I feel like I need to explain a few things to our viewers. I feel like there's a lot of technical jargon here. We are moving zero-rated to VAT exempt. What are we doing here really?
When you have zero-rated, what it basically means is that when you incur input VAT, that is, you have bought a product that has been charged VAT more than 100,000, you have paid VAT of 16%. You have paid VAT of 16. So from a zero-rated perspective, you can actually go to the government and claim a refund of that 16%. So which is then translates to more or less like government expenditure, because then they have to get that money from somewhere and give it back to you as a business. So when you go for to exempt, so and you incur that 16%, what happens is that you expense that 16%. You actually don't take it as a deduction, because mostly you can offset from the output tax, but for exempt, you just expense it and it stops there. So it's a good tool for the government, in the sense that they don't end up incurring a lot of tax expenditure.
On the same breath, VAT introduced on formerly exempt items, for example, renewable energy equipment, tourist vehicles, interesting items here.
And you see, when you look at it, there's policy reason as to why they were introduced. For tourism, of course, we wanted to encourage tourism. For renewable energy, of course, there's something we want to do about our climate and that agenda. Again, it goes back to what I mentioned earlier in terms of probably us critically looking at the list and ensuring that there's coherence with the broader government policy.
Two things now on the tax procedures and administration as we come to a close. One is the tax refund processing, which has been extended to 120 days. And there's a waiver of penalties due to ETIM's errors. What's your sentiments on those two areas?
Yeah, maybe to start with the waiver of penalties on the errors. I think that one is a fantastic one. And the reason I say that is because today, if even you go to your iTax, and I hope you can give me your details, I can check for you. So in terms of, you'll realize sometimes you have penalties that have been imposed. Maybe the system did not, record the payment in good time. Quite a number of penalties and interests that do not have a good basis. So remember what happened some time back is that the government repealed the window of waiver of penalties and interest. So without that particular law, so then the commissioners had that tied. They wouldn't have the capacity then to even reverse the genuine penalties and interest, the penalties and interest that have not been levied genuinely. So it's a positive one. For me, I still think that we can still go back to what we had before, waiver of penalties and interest, even on matters of misinterpretation of law. And I think the reason why the government, what I said, is that the government removed it because it was being abused. But if only we could tighten the nose a bit and ensure we have good controls, I think waiver of penalties and interest is a good to have within the provisions of the law. Of course, the other one that you have mentioned is the extension of 120 days to. So what happens is that today, if you apply for refund, the commissioner is given 90 days to come back to you. And if they don't come back to you, then that refund is deemed to have been allowed, or rather to have been approved. Yeah. But then if it is subjected to an audit, the commissioner is given 120 days. So within 120 days, he should come back to you and tell you, we have audited you, this is the amount that is due to you. So what you're basically saying is that those days being increased, from 90 to 120, from 120 to 180, probably because of the experience they have had in the past few months, maybe too short for them. But maybe we should increase the resources so that then timelines remain the way they are. Yeah.
Anyway, as we come to a close, just public sentiment and contextual issues, for example. Public perception matters to do with economic impact. How does this bill, when you look at it, respond to last year's public outcry? Do you feel like we have addressed some of these areas, particularly on Kenya's youth and the civil society? Or are we about to see some streets again?
Probably we have. I mean, if you look at, looking back, if you look at the Finance Act, and I like looking at that analysis, so most of those acts have been raising astronomical amounts, so to say. Like, I think we moved from 50 billion in 2022, 2023 we moved to 211 billion Kenya shillings. Of course, the bill of 2024 was 345 billion. Tax Laws Amendment Act was raising around 175 billion. So those numbers, in terms of being new measures, they certainly then speak to a pinch more into the pockets of Mwananchi. So I would say that maybe I've seen a bit of response to what happened last year, in the sense that we now do not have, you don't have new taxes that are being introduced. Although if you read it critically, you may see, some areas that revenue is being gotten, but not the way it was in the last year.
There you have it. That's Fredrick Kimotho, Associate Director at Deloitte East Africa, and also Tax Policy Lead there, and really helping us chew through the advanced stages, actually the introductory stages of this particular bill, 2025, which is right now in Parliament, currently under review by the Department Committee on Finance and National Planning. I hope you've taken your take out, and of course, just enlightening you more. What else can you do? Public participation is open. Make sure you do and give your part before June or the deadlines happen. Thank you so much for your time. I'll leave you now with the markets. That's it right here on the Trading Bell.